Hey everyone, welcome to Sum Zero. Today we're going to be talking about China and sort of how to navigate what is one of the higher growth parts of the world amidst some pretty turbulent and volatile markets. Today we have with us Hugh Dyus. I hope I'm pronouncing that correctly. Um,
Bias.
Hugh Dyus from Navis Capital. And they are experts in China. Hugh, this is obviously a very topical discussion, just given what's going on in the global economy and just given how big of a name, just China's just has such a huge impact on both the Asian markets, but also Western markets. Can you just kind of quickly give us a little bit about your own background and kind of how you landed on this niche?
Sure. So I've been in Hong Kong for more than 30 years. And in the early 1990s, I made a living helping European multinationals to set up businesses in China. So I've basically been following China from the beginning when it was opening up. And so I've had a long career in mergers and acquisitions and private equity. And for the last 7 years, I've been managing a niche listed equity fund, which includes China as its biggest single geographic market.
Got it. That's great. And, I'll say, we're going to get into a little bit of, we're going to talk about some single names, some single equity, single stock names that you know well. But one of the areas that I think is top of mind for most investors, at least here in the U.S., is corporate governance. Correct me if I'm wrong. Your angle is to kind of invest in companies that have, either private equity or VC backing as is. And so I was curious, is that typically from Western parties, or how do you kind of get your head around corporate governance as you look at the Chinese market?
Yes, so our strategy is a governance strategy. And I think the biggest risk of investing in Asian public markets is that the controlling shareholders don't necessarily treat their public shareholders well. Generally, you don't have good separation between controlling shareholding and management. So there's quite a lot of scopes for fun and games. So we like to invest only in activist private equity and venture capital backed companies. And that is not only Western private equity firms. You have Asian-based local firms that basically, underwrite deals and do due diligence to global standards. But we are discriminating in terms of which sorts of private equity firms we will effectively co-invest behind.
And from a market cap standpoint, can you describe your portfolio? Do you focus more on small caps, mid caps, big caps, or are you pretty much all over the board?
So by US standards, I think it would be small caps. So most of our companies are really in the range of $500 million to $2 billion. And that would count for maybe 70% of our portfolio. And then we might have the rest between 2 and 10 and a few under 500.
Got it. So when you're underwriting names in your portfolio, what would you say is your typical hurdle rate from a return standpoint? What sort of return hurdle are you going for?
All right. So we underwrite to kind of north of 20%. So essentially what we do, we look for companies that grow their top line, their EBITDA, their earnings by more than 20% per annum on a sustainable basis. And those are the types of businesses we like to back. So it's a kind of a boring fundamental strategy where we're just seeking to compound value over time by backing businesses that grow their market share in growing markets.
Makes sense. So let's talk about China a little bit, just sort of the macro backdrop. I think for skeptics out there that, they see China as this, central authority that has, the ultimate say and control over really all of the industries within the country. How do you think about the relative openness of the CCP, today? I mean, obviously they've taken a very harsh stance on certain industries. We saw what they did with the for-profit education industry in China. But can you just talk a little bit about, like what is the sort of philosophical and sort of just the relationship between the CCP and the financial markets of China, and like how should Western investors think about that?
Okay, so I think there's a big difference between rhetoric and substance. And because it's a communist political system, people tend to expect there will be a communist economic system. But Deng Xiaoping introduced a lot of reforms in the 1980s, where he basically opened up China and basically abandoned central planning and opened up China to foreign investment and technology. And so, of course, there are many sectors which are state-owned and state-controlled. But if you look at the economic sectors which are not state-owned, actually the economic system in China I would characterize as raw capitalism. And what I mean by that is, there's virtually no social security net. So people work hard, they want to make money, they save a lot of money, and it's imperative for them to do that. Because if they don't, kind of their families are not going to eat. It's much more capitalist and raw capitalist than people think, particularly in the consumer and segments of the economy that the government don't have their fingers deep into.
So yeah, why do you think it is that I think maybe the reputation is sort of the opposite, that it's not as sort of free market as as you're describing?
So I think the Chinese government are just absolutely terrible at PR. Obviously they control all information domestically. And they talk to an international audience the same way they talk to a domestic audience, which is a massive mistake because the international audience has a completely different perspective and they have many more sources of information. So I think they're just terrible at the way they communicate.
Yeah, I mean, I'm wondering how much of that disconnect has to do with like PR versus like the actual actions they're taking from a policy standpoint. But you still somehow you get comfortable with the names that you're invested in, obviously. Like, do you have some sort of like internal test or framework to understand like which industries are more or less susceptible to sort of surprise regulation than others? And how is that? And then of course, like that, I'm sure you factor that into the valuation, like your own valuation frameworks.
Okay, so I mean, in principle, we want to stay away from those industries which have a high degree of, if you want, political scrutiny and content, and there's a lot of regulatory risk. Of course, regulatory risk has increased substantially over the last 2 years, because there have been a series of unexpected regulatory actions. But highly regulated industries we will stay away from. And companies where winning contracts depends on connections and Guangxian political connections, we will also stay away from. We like to invest in companies where you can understand the underlying competitive dynamics and say this company is doing something better than its competitors, and therefore it should grow faster than everybody else. And that landscape should be kind of more predictable.
Yeah. What's your current view on their COVID policy? I mean, the zero tolerance policies, definitely been a headwind for Chinese company, listed Chinese companies. It has made, you could argue on the margin, like China, less investable. But do you have any sort of take on how we should be thinking about just their approach to COVID, and are there any do we, I think as the West, like misunderstand that policy at all?
Okay, so the zero COVID policy was very successful in the second half of 2020 and 2021 because the original and subsequent variants of COVID could be controlled with harsh lockdowns. The issue is that Omicron is so transmissible that the zero COVID policy is basically not working. It's like whacking moles, and it'll always appear again. So the costs of the zero COVID policy are basically now outweighing the benefits. So I think the reason that China is pursuing the zero COVID policy has more to do with politics. And at the moment, the politics is overriding the economic considerations. But I think after the Communist Party Congress in November, where Xi is expected to get kind of re-elected for a third term, I think that the political concerns and his re-election concerns will, if you want, dissipate, and they're more likely to go back to more sensible economic policies. I mean, obviously, they've already, if you want, been loosening economic policy to compensate for the impact of tight COVID. But I personally think it's a mistake, but it's driven by politics. But it will change because it's not sustainable.
And just to reiterate, you're predicting a November sort of inflection point for that policy.
After November.
After November.
After November. I don't think it'll come before November, but I think after November. So actually, if you look at the detailed implementation rules, they've already actually been relaxed. So there's already acknowledgement that the economic costs are too high and government officials are now being criticized for implementing policies too harshly. So there's already been some movement, but the rhetoric from the central government is still very tough. And I expect that to change after November. I'm not sure how long, but I'm sure it'll change.
So just going through the list of, arguably negative headwinds for China and for skeptics, they've been fairly pro-Russian as far as the Ukraine conflict goes. How much of a headwind is that, or is that not? You don't. I mean, do you factor that into your evaluation frameworks at all, or is it sort of a moot issue to you?
Okay, so I personally was shocked and surprised when the official rhetoric came out as so strongly pro-Russian as it was, because China's always had this position of neutrality on these types of conflicts. And with the Western response to Russia being so united and the sanctions against Russia, I was actually deeply concerned that there was a risk of secondary sanctions against certain Chinese entities. And so we actually substantially cut our exposure to China early on in the Ukraine war. But what's happened subsequently is that Chinese companies have been very, very careful not to do anything that breaks sanctions. And so even though the rhetoric remains pro-Russian, and of course, China's still buying a lot of energy from Russia, but they're not doing anything which crosses the red lines, which have been set, like supplying weapons and armaments and helping Russia otherwise break the sanctions. So I actually think the risk related to the war in Ukraine has substantially dissipated, because if they were going to help Russia in a more material way, I think they would have already done it. So I think they're being very careful to avoid the risk of that.
So under what scenario do you think China would more proactively help Russia, or do you really just see that as a tail risk at this point?
So, they're helping Russia in the ways that are understood and acceptable, like buying energy, but they're not doing the things that are unacceptable. And I think it's very clear, China is massively dependent on, Western export markets. They can't afford to run the risk of having those markets closed. So they're not going to take actions which will invite that type of retaliation.
So related to Russia, I mean, where do you see the risk of Taiwan aggression? Could that escalate, or again, do you see that as more of a tail risk?
Um, so I think that the experience of Russia in Ukraine has substantially reduced the risk of China being aggressive towards Taiwan. Obviously the war has gone very badly for Russia. If you consider that Taiwan is an island and the terrain of Taiwan, it's a much tougher job to invade Taiwan than it was to invade Ukraine. So I think that Russia's disappointments would have massively set back China's plans. And then, of course, they would have seen the much more unified response, against Russia. So I think that the risk of anything escalating in Taiwan has very substantially receded.
The other risk that I think comes up over and over again is just the delisting of U.S. or Chinese companies on U.S. exchanges. Any kind of additional color there? How much of that is just posturing and or is there something real there? I mean, is that something folks who own shares of Baba and Tencent and all the other big names in China, should they be worried about that?
I think that the Chinese government is probably going to cave in terms of access to the audit papers as required by the US regulators. But let's assume that they don't, and that there is this process of delisting which proceeds. So most big companies have already got secondary listings on other stock exchanges. So if you're an ADR holder, you can exchange your ADRs for shares listed in Hong Kong or elsewhere. The Hong Kong Stock Exchange is bending over backwards to basically loosen up the listing rules so that companies that don't yet have a secondary listing can have a secondary listing. And you also have a kind of a private equity industry who's looking for opportunities to privatize and then relist, ADR kind of listed companies where the valuations are bombed out. So I would argue that the fear of that is already substantially in the price. And that ultimately delisting will not result in a complete absence of liquidity and sell options for investors. It'll just be different. And it might take a bit of time, it might take longer to liquidate your stock than it otherwise would. But I think the companies where you'll be completely stuck in a private company will be very, very few and far between. And they definitely won't be the big names that most investors are invested in.
Yeah. So, I mean, just given the backdrop here, let's talk a little bit about just sort of the impact on valuations. A lot of Chinese names, interestingly, I guess up until maybe the first quarter of this year, at least the bellwether names were decimated. But I think more recently they've stabilized and I'd say over the last couple of months, many of them have actually gone up and performed relatively well. But just from a top-down standpoint, like, and it'll be interesting, I think, to compare this to U.S. names. Like, what is the average earnings multiple on the Chinese market today? Like, where's the market today, just at an aggregate level?
Okay, I find it very difficult to answer that question because it's so sector and company specific. And it also depends a lot on whether you're talking about an ADR or a share listed stock or something on the Hong Kong Stock Exchange. So what I will say is that the range of outcomes is quite wide across sectors and companies. But what that means is there's some companies which are just stupidly cheap. And so if I can take the example of AliBaba, because it's just such a widely held stock. If one kind of, looked at Bloomberg, it says it's trading today maybe at 10 times EV to EBITDA. But that ignores the strength of AliBaba's balance sheet, their 33% stake in Ant Group, their listed investment portfolio, their cloud business, all that type of thing. So if you treated those businesses of cash, and you also considered that they're burning $12 billion per annum in their growth initiatives, and you adjust the EV to EBITDA multiple for those things, I actually have them trading at a multiple of 1.5 times of their established Taobao and Tmall business. And to me, that is just ridiculously cheap. That type of example, where companies are trading at 1 times EV to EBITDA, where there are strong growing companies, is kind of not unusual. You can find companies like that. And to me, it's just crazy, and indicates, how far the disillusionment has gone with this series of shocks, which have kind of adversely affected sentiment towards Chinese stocks.
1 times EBITDA for Baba? Was it 1.5 times? Kind of
so 1.5 according to my maths. I can run through the maths in more detail if you want.
Yeah, no, look, I think there are a lot of people who follow Baba very closely, and everyone from Manish Pabrai to Charlie Munger, like, they've all gotten burned on the name. I personally own the name too, so I'd love to hear your sort of bottoms up on Baba, if you can kind of give us.
All right. So the market cap is about 275 billion, and they have about $50 billion of net cash. So the enterprise value is about 225, and they reported about $20 billion of EBITDA. So that will give you an EV to EBITDA of about 10 times. And that's the way most people are looking at it. So what one needs to bear in mind, that they're burning about $12 billion in growth initiatives in things like fresh grocery, group buying, things like that. And if you look at comparable listed companies in the same sectors who are burning money, they are trading on multiples of revenue. And so those growth initiatives within Baba have real value, but the market doesn't give any credit for that. And over time, they will bring in third-party investors into those growth businesses and attach a market value to them that people will be able to see. So anyone applying a price earnings or EV to EBITDA multiple, they're penalizing the company for the cash that's been burned, but those businesses definitely have value. That's point number one. Point number two is that a lot of people look at the decline in AliBaba's margins over time and says, oh, that's the impact of the regulatory pressure. But there's actually been huge change in the business mix of AliBaba. They originally are very much a marketplace business, where their revenue is the fees they charge people. And increasingly, their growth businesses are e-commerce businesses, where they hold inventory and they sell it and they report revenues and a gross margin. And so the change in the business mix is massively compressing their consolidated margin. And if you could track the margin with no change in business mix on a like-for-like basis, I believe their margins are much healthier and higher for their core established businesses than most people believe. Then the other thing, Alibaba's been a cash cow for so long, they've been investing in all sorts of things. So their balance sheet's exceptionally strong. And so I think instead of just looking at the 50 billion of cash, you should look at things that are near cash or could be equivalent to cash. And so their stake in Ant Group, their listed investments, further away from cash is their position in the cloud business, which is the market leader in China. So if you kind of put a value on all those things, then you'd find the value the market is ascribing only to the established, core business of Alibaba, Taobao, Tmall, things like that, is only $50 billion, and they're generating EBITDA of 32. So the way I look at it, if you value AliBaba and a sum of the
Wait,
parts.
sorry, Hugh. Just to take a second look at this. Sorry, you just said that those holdings, Taobao and the others you mentioned, are 50 billion in EBITDA in aggregate. Did I hear that?
So the established profitable businesses are 32 billion,
Right.
and they're burning 12 in other places, and they report 20.
Okay. So your adjusted EBITDA number is somewhere around 50. Am I hearing that right? When you kind of look at the
No. So they report 20. So their core businesses are making 32. And what I'm saying, if you value on the sum of the parts, you say, how much is the market valuing that business, which earns 32 billion of EBITDA?
Yeah.
It's a multiple probably of about 1.5 times, maybe 2 times. Then you add on the cash, the value of the stake and the value of the listed investments, all the other things, you'll get to the $275 billion of market cap.
Got it. And you what would you say would be a fair multiple for the stock?
Well, so in my view, the price of the stock is driven purely by sentiment and the latest news as to a regulator or has called somebody from AliBaba in for questioning versus a leak of data or whatever it is. People are not looking at the fundamental value. So my basic position is if you look at the strength of their business and what they're likely to be in 5 years' time, the current share price is a fraction of the true value of the group. And that's because there have been all these shocks to sentiment, and there are all sorts of hidden assets where the value is not very visible. And over time, management will demonstrate the value of those hidden assets. And people will say, oh, Ant Group is actually worth a lot more than I thought. And the cloud business is worth that. And the fresh grocery business is worth that. But at the moment, the market's not attributing value to those things.
Yeah. I mean, it sounds like you're sort of the camp that maybe it's a double at minimum over the next 5 years, but could be a 5x over the same period.
Yeah, so, I mean, the other big question is what's the impact of the regulatory change on their business? And everybody looks at the change from the, pick one from two policy, where essentially AliBaba and Tencent had completely separate ecosystems. And now they can't exclude anyone else from their ecosystem. So the initial effect of that is basically to increase competition. However, the business model that Pinduoduo had, where they basically built market share by selling product below cost, that can't be done in China anymore. It's basically the party won't allow it anymore. It's characterized as rash, imprudent expansion of capital. And so the ability of any new players to challenge the incumbents has been structurally undermined. So all the economies of scale, the flywheel effect, are going to just get stronger and stronger. So I believe they have a very strong fundamental business model with a lot of assets that the market are not recognizing. And so, yes, I think 2 times in 5 years is easy. And who knows what the upside is, because it depends a lot on what happens to sentiment and how good a job AliBaba does at attaching value to this whole variety of other assets they have under their group.
From a competitive standpoint, it sounds like what you're saying is that they're more likely to, their biggest competitive threats may be other Chinese big tech, not the next startup or the, kind of some of the smaller names.
Yeah, so I think it's very hard now for new competitors to raise capital and burn it aggressively to take market share away from the incumbents. So the incumbents will have their market strength reinforced by the current regulatory environment if you're looking at on a multi-year view rather than a 6-month view.
And I think the other thing people like to do, at least in the West, is sort of, compare the divisions of the business to Western companies. So somebody just asked on the call about AWS versus the Baba cloud business. Like, do you think Baba's cloud business could achieve the same margins as AWS? I mean, there seems to be some skepticism around how analogous these units are, but if you can add some color there, that'd be useful.
Yeah, so I think the skepticism is fully justified. There's a big open question of what type of margins they can achieve. But the point really is that Alibaba's cloud business doesn't contribute to group EBITDA. It's virtually zero still, but it's a massive business. It's going to have big value. It's hard to say how much, but it's not in the earnings or the EBITDA today, and there will be a contribution in the future. We just don't know the magnitude of it.
It's getting zero credit from investors today.
It's not getting credit in today's share price, and clearly it has substantial value. It's just very hard to quantify what it is.
Is it the largest in China?
Yes.
Right now, it is. Cool. So, I mean, would you say it's similar to AWS in terms of being kind of the go-to, at least for Chinese tech companies? If they're going to use cloud services, they're most likely on Baba Cloud.
So, I think there's a difference. Is there's more regulatory risk because of the environment in China. So, if the Chinese government decides that Alibaba is really kind of off limits for all sorts of reasons, that could affect kind of the future of Alibaba's cloud business, whereas AWS probably doesn't run that same type of risk.
Mm-hmm. And what's the value that you ascribe to Ant in your sum?
All right, so I've got it at the 33% stake as 100 billion. Of course, the range there is pretty wide. So my point is, if you do the sum of the parts, however you do it, you find that the core, proven part of Alibaba's business is valued at a very low multiple. And so you could put 50 instead of 100. It won't change the overall conclusion that Alibaba's core business is extraordinarily cheap by any standards.
Yeah. So just from a catalyst standpoint, your view is elections are probably the biggest upcoming catalyst to kind of change sentiment a little bit on the sector or the region.
So frankly, I think it's hard to predict exactly when sentiment's going to change. And, maybe the November Congress will be helpful when the COVID, zero COVID policy is more likely to be reversed. But I think at the end of the day, with the passage of time, people will see growth in earnings coming through, and ultimately that will be good for sentiment.
So let's go down the market cap spectrum a little bit. Tell us about another name that you view as extremely cheap and sort of emblematic of, the opportunities you're seeing, in the Chinese markets today. And it could be also, it may not, doesn't have to be China. I know you do some stuff in other Asian equities, but curious to hear.
So I'll pick the example of a company called Bairon. It's a Chinese company which provides big data and artificial intelligence solutions to Chinese banks. And Chinese banks use that data to enable them to make better credit decisions and to basically target customers with their online marketing campaigns and things like that. So it is it's a high growth business. They've grown their revenues about 45% per annum over the last 4 years. Their gross margins are more than 70%. They've been through their break-even inflection point, so EBITDA grew about 7 times last year. But as of today, the enterprise value of that business is negative. In other words, the market cap is less than net cash. So you have a growth business that's high margin with high operating leverage in a good sector that's essentially free. And if you buy the stock, you're basically getting cash at a 5-cent discount on the dollar, and you get a business for free. And to me, so that's an example to me as how stupid market prices have become.
And this is not a company burning cash? This is an EBITDA, no. This is a cash flow positive business?
This is a cash flow positive business, which is why their cash balances are so high. So when they IPOs in Asia are typically primary issues of new capital. They've not spent their IPO capital, and they've generated cash. And so their balance sheet's massively strong, and they're sitting on all this cash. And it's for free.
Incredible. So, I mean, play devil's advocate, like why are they not just buying up their own shares? What, like, how is that?
So in the Asian markets, there are a lot of actual structural impediments to stock buybacks. They're exceedingly rare. And this is actually a big difference between Asian equities and US equities. Outside of the property development sector, maybe a few other areas, most companies in Asia have very strong balance sheets. And so a rising interest rate environment, which is negative in the US for sentiment and for earnings, actually for many of these Chinese companies, they're actually going to be generating higher earnings because historically they've made nothing on mountains of surplus cash. And now they're actually going to make something on their surplus cash balances. And as the economic environment gets more difficult, they basically could use those cash balances for opportunistic acquisitions. So I think that the cash that the market previously attached zero value to is increasingly becoming more valuable in the current environment.
Got it. Does the fact that a lot of these names have private equity sponsors involved give them any incremental freedom to unlock shareholder value in these situations where you've got super strong balance sheet and the market's just not giving credit for even just like
so absolutely, the private equity shops will be continually generating ideas to basically unlock value, and they will be saying, well, maybe we should try and bring a strategic investor, or kind of maybe we should privatize, or maybe we should flick this on to somebody else who sees the value. So they will be generating a constant stream of ideas to try and crystallize, value that the market's not appreciating. And that's one of the merits of investing in private equity-backed listed companies. So what I should say, in the US, venture capital investors and private equity investors typically exit from a company when it IPOs. That's not the case in Asia. So the universe of private equity and venture capital-backed listed companies in Asia is very rich compared to what it is in the US. So you can actually build a strategy around investing in private equity-backed listed stocks, which I don't think will work very well in other markets.
Yeah, who is Bairon private equity-backed as well? Is there a prominent investor involved there?
Yeah. So we have Sequoia and Hillhouse.
Wow. That's incredible. So, and this would be like Sequoia's like Hong Kong team, most likely So
Sequoia China had a lot of press recently because they've had huge success fundraising while other managers are basically failing to raise money. So Sequoia China.
Incredible. What is the, sell side coverage model like in China? In the US, the sell side has a pretty significant impact on sentiment. Obviously a lot of investors, both on the buy side and retail investors, look at sort of sell side research recommendations. Do a lot of these names like Does Bairon have coverage at all? Like, are they covered by the sell side, or is it just too small of a market?
So Bairon is really a completely neglected stock. So on the earnings calls, there are generally two people on the call, and we're one of them.
You're one of them. That's amazing. That's amazing. Do you tend to know most of the CEOs of the companies that you're invested in your portfolio?
Yeah.
Wow. Do you feel like that gives you or maybe I'm just curious, like what level of insight you're getting with that direct line of communication?
So, I guess our approach to due diligence is very different. So my whole background is as a private equity investor. So a private equity investor basically hires all sorts of people to help them do due diligence. So the approach is, what do you want to know? How do you get the information? And then you process it. So we don't say, what's the available information? Let's process it and make a decision. Instead, we're saying, what information do we like to have? Where can we get it? And if we can't get information we think is important to investment decision, then we'll drop researching that idea. And so we'll only invest in things where we've managed to get the information we want to get. And so obviously management is a good port of call to get information, but they're obviously going to be selling their own story. So you want to go to other people. And one of the interesting things about our strategy is the private equity firms are sometimes very happy to share their views with us. And so we can ask questions like, what are the strengths and weaknesses of management? What are you doing to add value to that business? What's your value creation plan for it? Now, of course, the big listed firms like Carlyle and KKR, they can't talk to us because of compliance reasons and things like that. But other firms actually see it as part of their role to improve the IR of these companies, and they welcome approaches from us, and they give us a lot of insights.
Yeah, I mean that just sounds awesome. Much harder, I think, in the U.S. to get hold of, the IR teams or certainly C-suite for any given market cap level versus China. Do the PE firms that you guys deal with also tend to encourage sort of incentive stock option plans, for the companies that they're invested in? Is there that same culture of, giving employees equity incentives? Like
absolutely. So in the private equity toolkit is aligning the interests of executive management with the private equity shareholder. So you'll almost always see that type of thing. And I guess in Asia, the institutionalization and professionalization of management is a big thing. So you might have a family-dominated company with very centralized decision-making, and they struggle to attract strong middle management. And the private equity firm will basically help to professionalize the culture of the management team so that you can then attract much stronger middle management. And equity incentive schemes are part of that professionalization process. So the management teams within private equity-backed companies will tend to be deeper and more professional than those that don't have private equity backers.
From a fraud detection standpoint, are you generally piggybacking off of the sponsors that are involved, or do you do kind of your own independent, forensic work to just understand if there's any real fraud risk?
Yeah. So we do think that private equity participation reduces the risk of fraud, but we see it as, if you want, an indicator of good governance, but not a guarantee of good governance. So, private equity firms get burned quite regularly. Sometimes there's pressure to deploy capital. So we'll have our own independent view of the controlling shareholder and the family. And one indicator that I've actually found very reliable is the strength of a company's balance sheet. So what I've found in Asia is that bad actors, they typically want to trick and defraud creditors and bankers, not just public market shareholders. So it's much more common to find frauds in companies with a lot of debt on their balance sheets. But if you have a company with a very strong balance sheet with lots of cash, it's much less likely to be fraudulent. And it's also easier to audit the existence of cash than basically people who are playing games and overstating their revenues and their margins.
Makes sense. So let's talk about, I know we've spent a lot of time on China, but are there other countries that you see, the same kind of disconnect between intrinsic value and market price, where you're able to get comfortable with corporate governance? I mean, there are obviously a lot of countries out there where stocks trade at exceptionally low multiples, but maybe they're somewhat uninvestable regions. Where are you seeing kind of this kind of happy balance where you can get comfortable from a governance standpoint, and you're seeing like very attractive entry points?
So as a generalization, in today's market, China's the only place where valuations are ridiculously cheap. And so it's because you have kind of famous names saying things like China's uninvestable that situation exists. And so for people with a longer term mindset or a contrarian approach, China really is a very interesting place to look, provided you're selective and invest in businesses where their fundamentals are very strong.
What percent of your book is China today? Just ballpark.
So we have about 30% in China today, and the rest, across the rest of the Asian region. The valuations we pay across the rest of the region are much higher than they are for our Chinese book. And so it's, the investment case is very much based on the growth of those companies and the quality of their competitive positions, and much less on the value. But in China, the reason we're only 30% China is because of overall country risk. And sentiment could deteriorate further, but it's very easy for us to find higher quality companies at lower valuations in China than in other markets. We just don't want all our eggs to be in the China basket.
Makes sense.
So the bar on our China investments is exceptionally high.
Right. Zooming out a little bit, how much of a, because a lot of what you said about China is like sentiment based, which I think for many folks in the West is a function of what happens with U.S. rates. Do you look at the U.S. rates market carefully? And if so, like, do you have any view on like how aggressive the Fed is going to be over the next 6 months or so, and what that might do to the Chinese book that you have in your portfolio?
Okay, so I mean, obviously I follow macro news, but it would be completely wrong to seek insight on Fed policy from me. So my observation is obviously people underestimate inflation. Interest rates are rising faster than people think, and clearly they have further to go. So growth investors have got punished and hurt, and already there's been rotation from growth into value. The US capital market is enormous, basically compared to the Asian markets. At some point, it's logical to me that people will start to say, you know what, maybe I should be rotating also out of the US. And so, if I'm a US investor, I have, close to 100% of my assets invested in the US market. You could find in a rising interest rate environment that basically most US assets, all correlations go to 1, and it's not a good idea to have all your assets in the US. And so to go to other markets, to me, actually makes sense. And if substantial numbers of people start moving 1 or 2% of big portfolios into China, that could actually be a big move for the market. Now, it might not happen, but there's a possibility in my mind there might be rotation back into China in the same way we've had all this rotation out of China because of this series of negative shocks which have happened over the last 4 years.
Do you have any metric to quantify that rotation? Like, how much capital was pulled out of China, relative to, let's say, other regions, and sort of where is that allocation stand today versus maybe the average over the last 10 years, something to that effect?
Yeah, so there are statistics published in terms of weightings to China for international investors.
Mm-hmm.
And it's come off substantially over the last 18 months. And so, the average weighting to China for most international investors is probably about 4%. And that would compare to China's share of global GDP, which is probably around 15%, and on a purchasing power parity basis around 18%. So on any basis, international investors are massively underweight China at the moment.
That's actually really interesting. Do you follow India at all?
I do.
Do you see India as like sort of an allocation threat to China? Meaning, like, as people say re-enter the Asian markets, do you see India being benefiting from some of the negative headlines around China, or do you see kind of an all rising tides lift all boats scenario?
All right, so the way I see it, so we're very focused on governance and the trustworthiness, the ethics of the management and the shareholders and the businesses we back. And my view would be that Indian promoters are an exceptionally tricky bunch.
Okay.
And when we started our business, we included India, notwithstanding the fact I have this view, on the basis that if we are highly selective, we should be able to minimize governance risks. And we invested about 15% of our portfolio in India, and about 85% of the governance concerns that we identified were in our Indian portfolio. And so several years ago, we said, you know what, we're just not going to do India again ever, because they're just too tricky. And, of course, there are many war stories of private equity shops who've got taken to the cleaners in India. But it just seems to me that amongst the promoter class, if you're in India, if you're not ripping off your public shareholders, other people might look at you as if you're a little bit stupid. They almost take pride in doing it. And so I would say it's much easier to find more trustworthy management teams in China than in India, based on my experience.
Is that true at the large cap stage? Like, would you say that's true for, the Tatas of India and
okay, so Tata is an exceptional group with an excellent reputation for governance, but I think there are very few Tatas.
Okay.
And I would say if you're listed in India, the risk of games is very high, because the penalties for getting caught are close to nothing in India. If it's an Indian business that's listed in the US and the management team is an Indian management team based in the US, then you're likely to get US governance standards. But if it's an Indian team listed in India, much more questionable.
Hugh, have I left anything out? I feel like we covered quite a bit here.
Well, I mean, China is a huge topic. It's obviously a controversial topic. I would just encourage people to kind of think beyond the next 3 or 6 months and to have a longer term fundamental perspective, because there's definitely opportunities in China which are stupidly cheap. And ultimately, it's the people who are brave enough to step into the water when everyone else is running in the opposite direction that do very well. And if you manage to get a multi-bagger, it really helps drive performance across a portfolio. And
actually,
there's an opportunity for multi-baggers in China. If we're investing in a growth business and it's free because the enterprise value is negative, I'm not very worried about country risk, or political risk, or what's happening in the war in Ukraine. It's a growing business and I got it for nothing, and I could have a multi-bagger out of that.
One thing I wanted to add that I think is worth noting is just like, it seems like, at least as far as the big tech companies go in China, what impresses me about them is, the country has a reputation for this like copycat approach to business. When something's successful in the West, they build it in China, and there's like maybe a lack of authenticity there, and this has been borne out over many years. But it seems like, when you look at some of the big players in China, the level of innovation is actually quite high, and in some cases maybe surpasses what we're seeing with Western businesses. So, whether that's like the stuff Baidu is doing on the autonomous vehicle front, or what you see with Tencent and AliBaba in terms of building like true super apps that just kind of do everything. That's actually kind of been like really fascinating to me, that you've got something like a WeChat that, again, it's like, it's closer to a super app than anything we have in the West, but then there's this valuation disconnect where these companies are trading for levels that are well below their Western counterparts, even factoring in the fact that the S&P has fallen as much as it has. Do you think that people in the West will eventually recognize China for being like an innovation peer, and not just a kind of a copycat? There's a lot of, I think the narrative in the news is it's always about IP and like sort of all of the stuff that you see kind of talked about both during the Trump administration. Now Biden's been pretty hawkish on China as well. Do you think people in the West will ever give credit to these companies from an innovation and technology standpoint?
So, I mean, you're exactly right that there's a lot of innovation happening in China, and across a whole range of areas. And at the end of the day, it doesn't really matter if the press gives them credit. What matters is where that ultimately shows up in the numbers. The other point I would make is the business model of copying somebody else's original idea and doing it much better, improving the product or the idea or the service and delivering it cheaper. You shouldn't underestimate the power of that. There's less risk, and the operational delivery can be very strong. So clearly, if you're infringing somebody's patents or whatever, there's a problem. But I wouldn't completely disregard the imitators who actually do things better than the innovator. They could actually have more successful businesses.
Hugh, I want to end with a final question from someone on the call. Can you give one name of the best business in China, irrespective of current valuation?
Well, I really struggle to answer that question. To me, investment is always trading off the fundamental quality of a business against the valuation, and basically the alignment of interest and the quality of the governance. And to say, focus just on a single metric, it's just not the way my brain thinks. So I've never thought of that question, and so I don't easily have an answer for it. So maybe something like Wuxi AppTech or a name like that, but I just really haven't given it thought, so nobody should take my answer seriously.
Cool. Hugh, you've given us a lot of information. We'll have to unpack it. I'm gonna have to watch this again and unpack all this. But thanks again for taking the time. We're looking forward to staying in touch. And at some point, when sentiment does start to shift, I'd love to have a follow-up conversation with you and get sort of a look back on you know, how some of those sentiment changes have happened. Thanks again for joining us.
All right, bye-bye.
Appreciate it, Hugh. Thanks.